You hear me now? Is it better? Yes. Oh dear. So have we just gone through the whole of this so far without any? Thank you so much for letting me know. I did test it and it did tell me that it was working. Anyway, modern day tech, what can you say? So in which case, this is a real shame because we've actually missed everything that I've been saying so far. Okay, basically then we'll just start with we'll have to just go very, very quickly through what we've been. So I've been talking about the RBA. So this is the RBA rate decision that we've been talking about. The RBA is not expected to move on interest rates. However, I mean, it's worth bearing in mind what they said at the last meeting, where they said there was no need to hike rates, but they were also wary of price risks. So that means that they are actually still very concerned, I would say, about the prospect of high inflation. And the fact that they're still talking about sort of rate hikes does mean that they're potentially more hawkish than other central banks, and particularly the Federal Reserve, who have made it clear that the next move they make will be a rate cut, even if it is just one rate cut this year. So the RBA, as I said, they're sort of going to be weighing up mixed economic picture. We've got low growth in Australia, but we've also got very stubborn inflation and the risk of also strong job creation. I mean, if we just look at the jobs data recently, we've seen very strong jobs creation, even if the unemployment rate behaved in line with forecast. Job creation was stronger than expected. So it's interesting because it also comes at a time when the Federal Reserve have been talking about cutting interest rates just once rather than 3 times that they were talking about in March. But the market is still pretty convinced that the Fed will cut twice, although after the cooler than expected consumer inflation and PPI inflation. But actually here we can see we've had this sell-off as the market just really does digest what's going on. This candle here is the Fed candle, and the day that we got the inflation data from the US. You can see that long upper wick there. That actually shows there was little buying demand up at those upper levels. So as far as levels to be watching here, this one here, 66 on the downside, that's going to be one to watch. We can see that's been pretty key on a couple of points across the past year. Also, if we get a break below that, then watch out for the 200 SMA there at 65.50. On the upside, again, key level here, I would say 66.50. Again, it's a level that's just capped gains. So we can get a rise back above there, then that does actually bring the potential to bring 67 back into focus. But that will be dependent on a slightly more hawkish sounding RBA compared to the Federal Reserve. So we're just going to keep moving now. We've got also US retail sales. Okay, retail sales are actually expected to grow 0.3%. I think that it's fair to say that the data that we're getting through from the US at the moment is creating a little bit of a mixed picture. We've got the inflation data, which the market interpreted as cooling by more than expected because that was on the monthly basis, but actually annually it's still up at 3.4%, which is well above the Federal Reserve's 2% target level. So I think it would be dangerous to be getting overexcited just yet about Fed rate cuts because of that inflation level being so high still. The market is pricing in 2 rate cuts, as I said, rather than the one that the Fed actually pointed to, which I think is really important. So just as far as, and we can see, this here, that was that Fed meeting candle, long lower wick, reduced selling demand at those lower levels, powered higher since. So I think the Federal Reserve interest rate decision and that meeting this week was actually supportive of the dollar. If we get strong retail sales data in next week, then I think there is a potential to take out that 105.70 105.70 level, which could then bring the 106 back into play. just on the downside, yeah, if we get a break below, so if you get weaker than expected retail sales, which is just going to add to that idea that, you know, wholesale inflation was weaker than expected this week, jobless claims rose to a 9-month high. So if we get weak retail sales, it could just add into that narrative that the US economy is slowing, and that will bring that 105 level back into play. Below that, you've got the 200 SMA at 104.40. So also, I mean, we just have to have a quick look, don't we, at what's going on in the US stock markets, because whilst we've got the US dollar, which is pushed higher, you've also got record highs on the Nasdaq and the S&P. And I think there is, whilst there is that sort of the narrative of the Federal Reserve, you know, cutting rates, the next move is going to be a rate cut, cooling inflation points to it. You've also got that AI story, and we mustn't forget how important and how relevant Apple is as a driver of you know, within that Magnificent Seven of the S&P 500 and the Nasdaq. And so, you know, we've seen strong gains in Apple, which have really helped the Nasdaq push higher. Again, talking about next week's data, if we get those retail sales data, I think the market's been very much a case of bad news is good news as far as the market's concerned. So if we do get weaker retail sales, then we could see that push the Nasdaq to further all-time highs. Just be wary there of the overbought here and the RSI, because that could mean that we're going to see a bit more consolidation at these levels, or even a break lower to sorry, that's 19,500. That's sort of just a psychological level in there. Next one on the upside is going to be 20,000. On the downside, really, there isn't much in the way of support until you get down to around that 19,000 level. So that would be sort of on the downside. There's not a huge amount to be watching on the support side of things. So let's just have a look to see what else we've got going on this week. Oh, I think the other one really to watch is gold, isn't it? Well, you know, when we're talking about what's going on with the Federal Reserve, and we're talking about what's going on with the US dollar, let's just take a look. And actually, gold has risen this week. Okay, so it's risen for the first week after 3 weeks of losses. I mean, it's not really, it's risen, but it's not really done anything dramatic. It's still trading below this sort of trend line, which sort of dates back to April. But I think broadly speaking, we are sort of within a familiar territory. I mean, sellers will need to sort of take out the 2285, 84 level, 2280 level to get a lower low and to extend that bearish move. However, might not do it on the upside. You know, we've got the RSI in neutral, so it's not really giving away too much. It seems to be a bit more of a consolidation phase, I guess. You know, it's trading within a pretty familiar range here. So, you know, on the upside, watch for a rise above the 2345. That's the 50 SMA to bring that June high back into play at 2387. So next big one to be watching, Bank of England interest rate decision. Listen, the Bank of England, I don't think are going to cut rates. And the reason that I don't think they're going to cut rates is because we've not really heard anything from the Bank of England. In fact, we haven't heard anything from the Bank of England because of the announcement of the elections. And that means that there's a blackout period for the policy speakers. And we got that election announcement when there was the inflation data. So we haven't really heard any commentary from, well, we haven't heard any commentary from the Bank of England on UK inflation after the inflation data, sorry, jobs data. No, sorry, it was the inflation data. God, I'm getting my dates wrong. So it was the inflation data, which cooled to 2.3%. So it cooled to 2.3%, which was close to the Bank of England's 2% target. But service sector inflation is still proving to be too sticky, I would say, for the Bank of England's liking to want to start cutting interest rates. We've also seen data this week, such as the GDP data, showed the UK economy stalled in the in April. We've seen that unemployment's risen to a 2.5-year high, but we've also seen that wage growth is really still proving to be pretty sticky as well. Both wage growth and service sector inflation are hovering around that 6% level, which I think is just going to prove too high for the Bank of England to cut right now. I do think that the Bank of England is very much on the trajectory that things are moving in the right direction and that they intend to cut, and that the potential plan, I think, will be to cut in August by 25 basis points and again in November. Now, it's just a really interesting time. We've also got UK inflation data, which is out just the day before the Bank of England interest rate decision. But really interesting point on the chart here. Look, we can just see it's testing that 127 level. Okay, the 127, it's been a level that's sort of capped losses, I would say, between 127 and 126.85. That zone has proved important. We're just breaking out of that upward trend that it's been in since the end of April. Now, if we get a break below that, watch here. This is the next one to be watching for, 126.45. That's the 100 SMA. Below there, watch, I'd be looking for the 200 SMA around the 125.45 level. This is a fairly strong, we're seeing some fairly strong bearish engulfing candles. The RSI has fallen really, and I think if we had a look at the MACD, that would almost certainly be showing a bearish crossover. So, you know, I think there is supportive. There are suggestions that the that the pound could weaken further against the US dollar, especially if we hear the Bank of England basically tee the market up for a rate cut in August. That's going to be ahead of a rate cut from the Fed, and it does also make two rate cuts from the Bank of England look more likely than 2 rate cuts from the Federal Reserve. Obviously, the later the Fed leave that first rate cut, then the less likely there will be to have a second one this year. So that's that. Also, let's just take a quick look at the, I'll just see what time it is actually, sorry, bear with me. Okay, we're ticking on. So what we'll do is we've done the RBA, we'll give the Swiss National Bank a miss right now. We've done Bank of England, right, we've got the PMI data. Loads going on in France at the moment, obviously with the French elections. We've got data coming through for the PMIs for Germany and for the Eurozone. I mean, basically and also the UK, but we've sort of covered the UK. I think, you know, it'll be the main focus there is the Bank of England. As far as the PMIs are concerned, you know, we've seen this trend in the Eurozone and in Germany where we've got improving services. Services are strong. I mean, look at Germany, services up at 54.2. Manufacturing is starting to show sort of signs of the contraction easing. So that if we see a continuation of this trend, then that's going to be good news as far as the euro is concerned and stocks. And my gosh, the euro does need some good news right now. I think it's had a really quite a tough day against the US dollar. If we just have a look here, it's fallen back into this fallen channel that dates back to the beginning of the year. We've seen a failure there at the 100 SMA, faced rejection, fallen lower, and that's basically on concerns over the political concerns, the uncertainty regarding the French election that Macron called at the weekend after his party performed poorly in the European parliamentary elections compared to the right-wing, far-right Marine Le Pen's party. So he's called snap elections, and the big concern actually is that Marine Le Pen could win. And then, I mean, how is that concerning for the markets? Basically, France already has there are, you know, some worries over the level of France's debt, and I think the big concern is that sort of a far right wing party could push up spending, and push those debt levels into dangerous levels, and that is what we're seeing played out on the euro. We're also seeing it played out on the CAC and also the German DAX as well. So, you know, it is really affecting just the mood broadly in the Eurozone. So just what levels are we going to be watching for here? I mean, it's already taken out my levels, so we're just going to reassess. Down here it's the 106, isn't it? We're down here at 106. Let's have a look. Yeah, 106 level. I mean, you know, we've got this long lower wick here, which, to be fair, does suggest that the market there wasn't much selling demand at those lower levels, which is an encouraging sign. But still, I mean, encouraging for now. This trend is clearly one that is going lower. We've, you know, it's back in that falling channel, failed at the 200 and the 100 SMA. I would be watching out on the downside to take out that 106.70. That was yesterday's low, and if you can take out that, then you could be looking towards that 106 level. This is supported by the RSI, which is also in lower, below 50. So on the upside, any recovery first needs to get over the 200 SMA around the 107.80 level, and above there you've got this 108 level, which is going to be pretty key for any recovery to get towards that 109 level. Just having a quick look at the DAX. Again, look, there we're seeing this really strong bearish engulfing candles, two of them. You know, this is a pretty bearish look on that chart. Just finding support now at the 100 SMA and at that 18,000 level, two pretty key levels to be watching. A break below there, you know what, be looking here at around the 17,700. That was this level sort of in the end of mid-May. Any recovery, first of all, needs to take over the 8,240 level. That was the late April highs, in order to bring the 8,000 sort of 650 level back into focus, which is this week's high. But as I said, you know, that's looking like quite a bearish chart right now. So that is all. It's 1/2 past. I'm just going to quickly do what I did at the beginning, because obviously there was no sound at the beginning, which is a bit frustrating. But basically what we were looking at the beginning is we have Chinese retail sales, and we've also got China industrial production. Now, these are key figures for assessing how the economic recovery is panning out in China, given that, you know, on a global stage it's been watched very closely, given it's the world's second largest economy. So we have seen sort of data showing that any recovery is not going to be in a straight line, and there are signs that the stimulus measures from Beijing are helping to support the economy, but you know, we're not seeing that sort of big bam reaction or move higher, in the sense of, you know, booming economic growth just yet, but this is more of a steady as you go. We're expecting to see retail sales improve from a fairly low base in May, but we're seeing industrial production is expected to fall slightly. Just as far as industrial production is concerned, this tends to hit oil prices. Oil is setting up for a really strong rally this week, up 4%, its best weekly gain since its strongest weekly gain in 2 months. It's basically on the outlook for demand, which is expected to improve. So if we get stronger than expected Chinese industrial production, combined with the sense of falling inflation data in the US, then we're getting some encouraging signals as far as the demand outlook for oil is concerned. Oil needs to rise above, this is a really key area here, around the 79.50 to the 80.50 area zone, where you've got the 200 SMA, you've got this week's high, you've also got the late May high all in there. On the downside, watching out for support. If we get weak data from China, then we could see some oil prices come down to the 77 level, and below there isn't really a whole lot of support down until the 72. I also just took a quick look at the China 50. This is quite interesting. You know, we've seen this trend lower from just below 13,000, been trending lower across, taking out the 50 SMA, taking out this resistance here at the 12.2 or 12,300 pretty much, but we're finding some support around the 100 SMA here. So, you know, if buyers can look to end the week above that level, if buyers can look to push above that level, then that would be a really encouraging sign that the bottom is in. But if it doesn't, a break below the 100 SMA could open the door to the 200 there, just below the 12,000 level. So if we get weak data, then just watch out for some selling off in Chinese stocks. So that is everything from me today. I do hope that you have enjoyed. I've just got a quick question here about the recording. Yes, you will email you with a recording. Just beware, I had some technical issues for the first, I would say 10 minutes, so there's no sound. So just fast forward for the first 10 minutes and then you will hear the sound on it. So I hope that helps, and thank you very much. We'll see you next week.